if I were to say, pick 2 asset classes, Steve, that you would invest in that would be best diversified, you would probably say equities and fixed income. So we looked at that. We have a very long-term track record for equities and fixed income, and we said, okay, let's look at these 2 asset classes, but also let's look at the realized correlation between the 2 asset classes. But let's assume different levels of correlation. Let's assume that instead of the minus 0.4 correlation that has existed for decades between equities and fixed income, what would it look like if it were 0 correlation between the 2? What would it look like? What would it look like, or what would the results be if it were 1.0 correlation, if they were perfectly correlated? And so we did kind of that little bit of a stress testing to see which contributors would improve diversification. So what we ended up realizing was that there's really 3 components of diversification. To more directly answer your question, that is low correlation itself. So if you have a correlation of 0, low volatility, and also the concept of negative correlation or a hedge, right? So those 3 factors, if you break up correlation into those 2 components, those are the 3 ingredients that we saw that can contribute to a diversified portfolio.